The Bitcoin halving stands as a pivotal event in the cryptocurrency landscape, fundamentally altering the supply dynamics of the world's leading digital asset. Anyway, feel free to save these no copyright AI image results. This programmed reduction in new Bitcoin issuance is not merely a technical adjustment. It is a cornerstone of Bitcoin's economic model. Understanding its mechanics and historical implications is crucial for investors, analysts, and miners navigating this evolving market. Each halving event cuts the reward for mining new blocks by half, directly impacting the rate at which new Bitcoins enter circulation. This scarcity mechanism is designed to mimic the finite nature of precious metals, ensuring a predictable and diminishing supply over time. For market participants, the halving represents a critical juncture, often preceding periods of significant price discovery and market reevaluation. At its core, the Bitcoin halving is an automatic adjustment embedded within Bitcoin's protocol. Approximately every 4 years, or more precisely, every 210,000 blocks mined, the reward given to miners for successfully adding a new block to the blockchain is cut in half. This process will continue until the maximum supply of 21 million Bitcoins is reached, estimated around the year 2140. This pre-programmed disinflationary schedule is a stark contrast to traditional fiat currencies, which are subject to central bank policies and potential inflationary pressures. The halving ensures a predictable and transparent reduction in supply, making Bitcoin a truly scarce digital asset. It reinforces Bitcoin's value proposition as a store of value, independent of human intervention or political influence. Bitcoin has undergone 3 previous halving events, in 2012, 2016, and 2020. Each instance has been followed by a significant bull run in Bitcoin's price, often reaching new all-time highs within 12 to 18 months. While correlation does not imply causation, the consistent pattern suggests a strong relationship between supply reduction and price appreciation. The 2012 halving reduced the block reward from 50 to 25 Bitcoins, preceding a monumental price surge from around $12 to over $1,000. The 2016 event saw the reward drop to 12.5 Bitcoins, leading to the 2017 bull market where Bitcoin approached $20,000. Most recently, the 2020 halving, which cut the reward to 6.25 Bitcoins, ushered in the 2021 bull run, pushing Bitcoin past $69,000. These historical cycles underscore the market's anticipation and reaction to the supply shock. For Bitcoin miners, the halving presents a direct and immediate challenge to their revenue model. Their primary income source, the block reward, is suddenly cut in half, meaning they receive fewer Bitcoins for the same amount of computational effort. This necessitates a rapid adaptation to maintain profitability and operational viability. Miners must become significantly more efficient, focusing on reducing electricity costs and upgrading to more powerful, energy-efficient hardware. The halving often triggers a period of consolidation within the mining industry, as less efficient or undercapitalized operations may be forced offline. This can lead to a temporary dip in the network's hash rate, though it typically recovers as more efficient miners expand or new optimized facilities come online. Post-halving, transaction fees become an increasingly important component of miner revenue, incentivizing the processing of more transactions and contributing to network security. The Bitcoin halving is a practical application of fundamental economic principles, primarily supply and demand. By systematically reducing the rate of new supply, while demand potentially remains constant or increases, the price of Bitcoin is theoretically driven upwards. This mechanism is often analyzed through the stock-to-flow model, which measures the existing supply of an asset against its annual production. Bitcoin's disinflationary nature stands in stark contrast to the inflationary policies often pursued by central banks globally. In an environment where fiat currencies are subject to quantitative easing and increasing money supply, Bitcoin's fixed and diminishing supply offers a compelling alternative. This inherent scarcity is a core tenet of its value proposition, positioning it as a potential hedge against inflation and a robust store of value. The anticipation of a Bitcoin halving often creates a unique market dynamic. Investors and analysts frequently engage in buy the rumor, sell the news behavior, accumulating Bitcoin in the months leading up to the event. This pre-halving accumulation can contribute to price appreciation even before the supply shock officially occurs. However, the immediate aftermath can sometimes see a temporary dip as short-term traders take profits. Long-term investors, often referred to as HODLERs, tend to view the halving as a confirmation of Bitcoin's long-term scarcity and value proposition. Their conviction often strengthens post-halving, contributing to a reduced selling pressure. The increasing institutional adoption of Bitcoin also plays a significant role, as large entities may view the halving as a catalyst for long-term growth, integrating it into their investment strategies. While historical patterns suggest a positive price impact post-halving, it is crucial to acknowledge that past performance is not indicative of future results. The Bitcoin market is maturing with increased institutional participation, regulatory scrutiny, and macroeconomic influences. Future halvings will occur within a different market context than previous ones, potentially altering the magnitude or timing of price responses. One challenge lies in the increasing reliance on transaction fees for miner revenue as block rewards diminish. If transaction fees do not grow sufficiently, it could theoretically impact miner profitability and consequently, network security. However, the ongoing development of scaling solutions like the Lightning Network and the increasing utility of Bitcoin for various applications suggest a growing demand for block space, which could drive up fees. The Bitcoin halving remains a defining feature of its economic design, a testament to its decentralized and predictable monetary policy. It is a powerful mechanism that reinforces Bitcoin's scarcity, distinguishing it from traditional assets and fiat currencies. For crypto investors, financial analysts, and Bitcoin miners, understanding the halving is not just about predicting price movements. It is about comprehending the fundamental value proposition of Bitcoin. As Bitcoin continues its journey towards global adoption, each halving event serves as a reminder of its unique disinflationary path. It underscores the network's resilience and its commitment to a fixed supply, making Bitcoin a compelling asset in an increasingly uncertain financial world. The halving is more than an event. It is a continuous process shaping the future of digital finance. Don't forget to subscribe for the next video. Stay tuned.